We still see AI as a positive storyline. We still see positive CapEx spending. And so our view on tech is that the EPS here going into next year will still be around 20%. It's still a sector that we really like. If I step out more broadly and look at the market, I still think this is not going to be a stellar earnings season, but it'll be okay, if only because there's a correlation between economic growth and with durable profit growth. And we saw that Q3 GDP number this morning. It's just below 3%. That is positive. So our expectation is that going into next year, we'll still see 8% EPS growth on the S&P. And this year, for this quarter, it's not going to be so bad.
All right, so you're saying earnings so far have been okay, but it is okay, good enough to keep this market at 22 times forward, because I know looking forward by the end of next year, you're looking for SPX at 6,600. That's a jump.
Yeah, so 6,300 by June, 6,600 by the end of the year. Again, this is a story about positive earnings. It is a story about the Fed continuing to reduce rate. And it's also a story that the macro data, for the most part, is positive. And so we think that this will continue to be supportive for equities. To your point, the broad market is definitely not cheap. We don't think it's overpriced, but that's why you need to step in selectively to sectors that are more attractive from a valuation perspective. I would look here, for example, to financials, which we can talk about more. This is one that is one of our favorite sectors. And utilities is actually another sector, Martin, that we quite like. It's trading from a valuation perspective below its history, below the S&P. And I do think utilities, while no one gets excited about utilities, it has some interesting both growth and defensive characteristics.